How many of you are thinking that the debt funds, for example, debt mutual funds or investing in cooperative fixed deposits, investing in debentures, bonds, are a risk-free investment? There are a lot of people out there are thinking in that way. So today I am going to reveal 5 tips to protect yourself from future whenever you are investing into the debt fund. Debt funds doesn't come as a risk free. Again, debt fund doesn't come as a risk free asset. It has its own risk. Please keep this 5 tips in your mind, or you can say it as a 5 lessons in your mind, and keep this in your mind while investing on any debt funds. Let's get into the topic to find out what are those 5 lessons or tips there. Hi there, this is Ravi Sharma here. I'm a generational wealth coach. The so-called debt funds has come undergone over the last year. You have seen lot of companies bonds, especially ILNFS, DHFL. All these funds got downgraded because of their the credit rating coming down, and because of they are defaulting in terms of interest payments and so on. We all think that investing in the debt funds is risk free. So and there are a lot of people out there investing in debt funds thinking that they will get a return exceeding the inflation rate. But what happens nowadays is we are losing our investment when we are investing into the debt funds. So always keep in your mind is investing in debt funds. Don't invest your money into the debt funds if you are looking into the return on capital. If you are looking into something called return of capital, then you should get into the debt funds, and you should be very careful while selecting the debt funds. So let's get into the topic. What are that 5 tips and 5 lessons you should keep in your mind while investing in the debt funds? The first one is tamper return expectation. So what is this tamper return expectation? Traditionally, investors used to invest in the debt funds to preserve their capital, right? So after the demonetization happened, so the bank fixed deposit interest got reduced, and a lot of interest rates of the debentures bonds got reduced, and that so-called the return on capital from the debt funds has slowly got reduced. So investors, as I told you, investors should income on the fixed the fixed deposit or any debt in funds only if they are looking into the return of capital. It is just to preserve your capital. Okay, so don't keep a big expectation in terms of returns from the debt funds. Normally, on an average, if you invest in, not in fixed deposit, if I talk about the debentures or any funds, any infrastructural funds, or any the company deposits or bonds, it just gave 1.5% in 1.55% more than the income, more than the inflation rate. But one thing you have to keep in your mind while investing in your debt funds is what is that you are looking, what is the taxation, what is the time that we say locking period, and what is the expense ratio which you are incurring. So that's what all called this tamper return expectation. So keep this in your mind, these all factors, so that you are thinking according to your goal, and not just in terms of returns. So that's all about the first point, which is tamper return expectation. The next the second tip is credit risk not restricted to one category. So what is, in the past year, credit risk means only financial healthiness, right? It is credit risk is not restricted to only the financial category. Right? There are a lot of people out there. The credit rating has come down. Still the SEBI or people are, any mutual fund managers are still investing in that company, because it's not only the credit rating some decides the, yeah, obviously that is a benchmark for the health of the fund, but it is not the only factor which decides, the health of fund, right? So the main thing which you have to keep in your mind is you also have to see all of overall the, health, in terms of like how company's perception in the market, how the employees are, employee perception within the company, and how the news are happening. Then what is their sales? Are they growing or not? And these all things comes into picture. So don't restrict yourself on the credit risk as a one category. So look at overall perspective. Okay, so there are a lot of things has been downgraded, but still, DHFL, the Reliance bonds got downgraded because of their credit rating. Okay, so but fund houses are still investing in it. Okay, so by taking a credit risk, calculate your credit risk before investing in any of the debt funds, but look at as an overall perspective of the company. So that's all talks about credit risk not restricted to one category. Let's move into the third tip, that is FMPs are not entirely safe. So what does this FMP means? FMP stands for fixed maturity plans. You would have seen there are a lot of fixed deposit, especially in the companies deposits, or even in any cooperative society, right? So there are a lot of fixed maturity plans over there. So we think that that is a completely safest place to invest the money, but it is not. Why? Because you should also see your money is restricted in terms of time. Means you will not be able to withdraw any money. You will not have a liquidity, and you will have any default risk. Means what happens if, as I told you again, gave an example of, DHFL, which got defaulted in their payment. And also there are a lot of even banks are a separate talk altogether, separate matter altogether. But when it comes to credit societies, right, still we will have a credit risk, default risk in our mind. Keep that in your mind whenever you are in investing into the fixed maturity plans. You should take care of your, you should think in terms of liquidity, in terms of again taxation, and availability of the, for the availability to withdraw the amount, or any expense ratios, all these things. That's all talk about. Fixed maturity plans are not entirely safe. The next tip is size matters. So what is this size matters meaning? Okay, so when it comes to size, right, so we normally invest in when we take the liquid mutual funds. These all are the short term funds. The size matters means size in terms of term, or time, or size in terms of how much fund are available, how many, or we say asset under management, right? AUMs or NAVs, net asset value, all these things comes under when we talk about size. And each has its own drawbacks and its own advantages. Short term, when you come into liquid mutual funds, we will invest in the short term funds like treasury bills, commercial paper, and so on. And when you look into the larger debt funds, there is a high chance of having a credit risk, and the relative to smaller ones, right? So think about size in terms of time, in terms of the NAV, net asset value, before you investing into any debt funds. So the last one tip is get a financial advisor. There are a lot of people out there, be whether they're investors or anybody, they just invest in the fund, direct debt fund, because they see the reduced expense ratio, and there is no intervention of any other people out there. But those people are facing a problem when they are not able to get a proper return, or proper, when they lose their capital uh, because of the credit risk which they face and default by the companies. Always have a financial advisor with you, because they are the one who can calculate the way how you can take the risk, and they will know you what is your risk capacity, risk tolerance level, and also based on that they will be able to suggest which debt funds you should focus, so that your capital also will be on under protection, and also you will get a small rate of returns just above the inflation rate, right? So that's on the final tip called get a financial advisor. So just recapping all the 5 tips. First one is tamper return expectation, and next one is credit risk not is one category. Credit is not restricted to one category. And third one is fixed maturity plans are not entirely safe. And fourth one, size matters. And last but not least is get a financial advisor. Hope you have understood something out from this. And please take care of your money before investing in debt funds. Never ever think that debt funds comes with risk free in a part. So every investment has its own risk. Have your financial advisor. If you feel that this has been added any value to your investment or your learning, There is a link given in the below description. Please join that Facebook VIP group. From there, I will take you up with the different way of different level of journey in terms of your finances, and I'll help you to build a generational wealth. Let's meet on next video. Till then, bye bye.